Welcome to The J-Row Show. On this podcast, your host, John Rotanti, interviews experts in and outside the world of investing. The J-Row Show dives deep into what it takes to achieve mastery and sustain top-level performance. As a quick reminder, this podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. All opinions expressed by John or any of his podcast guests are solely their own and do not constitute formal advice or recommendation. Now please enjoy this episode.
I'm John Rotanti, and this is The J-Row Show, a podcast that explores what it takes to achieve mastery, sustained performance, and longevity. The show hopes to uncover the processes, structures, frameworks, and mindsets that masters put in place to maintain winning performance in their respective fields. Today, I am joined by my friend Quoc Tran. Quoc is co-founder, chairman, and chief investment officer of Tran Capital. Prior to founding Tran, Quoc spent over 20 years at Kemper Investments, Goldman Sachs, White's Funds, and Latif Investments, and he led a buyout of the predecessor firm to Tran Capital. I've said on the platform, now called X, that Quoc is one of the few investors on this planet I'd want to manage my own money. I'm so honored to learn from Quoc today. Quoc, welcome to The J-Row Show.
Thank you, John, for that generous introduction. I'm delighted to be here.
Quoc, tell us about Tran Capital.
The Tran Capital is a boutique, concentrated, long-only U.S. equities firm in the San Francisco Bay Area. We manage about $1 billion, and our client base is about half high net worth families and half institutions. Our predecessor firm was founded in 1974. I joined the firm in 2005 and led a management buyout in 2017.
Thank you for that intro. So what type of investor are you? What I mean is, what is your investing philosophy? Do you label yourself as a value investor or a growth investor, or do you prefer to avoid labels?
You know, we take Buffett's 20 punches very seriously. We are a concentrated investor in that we want to buy the best businesses that we can find that are selling at reasonable prices and hold them for a long time. We ask questions like, what businesses would we like to invest if we can envision buying the whole company? What businesses provide essential services that can withstand volatile markets and periods of deeply concerning geopolitical risk? So we are growth investors, but we focus our attention on 20 to 30 of our best ideas.
What does your typical stock holding look like, Quoc? So what's the typical multiple it trades at? What's the typical growth margin or return on capital profile? Is the company typically buying back a lot of stock? Does it typically pay a dividend? Or maybe a better way to ask this is, can you share some portfolio level metrics with us, such as the average return on equity or the average PE ratio of your portfolio?
And that's a great question. So typically when we're starting a position, these are great businesses, but in order for them to be reasonably priced, there's often some cloud or some near-term problems. So at the point of entry, the metrics may not look like what it may look like when it's seasoned. But overall, our portfolio typically grows earnings about 50% faster than the overall market. We enjoy a higher ROE, and we trade at a PE multiple that may be one or two multiples above the market multiple on forward 1 year earnings. But because of our higher growth rate, on a 2 to 3 year earnings, our multiples are often lower than the markets. Our weighted average market cap is also about half of the S&P 500. So we're focusing on smaller companies that can grow much faster, that enjoy a higher ROE, and trades at a slight premium. Perhaps I can break this down in three categories of companies that we typically find ourselves investing in. And this is from some work we did looking back over 20 years of investing. The first category that we like are compounders. So these are companies that we think can grow for 10 plus years. The second category that we seem to traffic in are picks and shovels companies. So they provide services to grow in industries. And then the third category that we traffic in are special situations, and these are often corporate spinoffs from that are underappreciated and perhaps underfollowed on Wall Street, and we often find great opportunities there.
I love that you categorize your 20 stock portfolio into those three baskets, and that you are buying higher quality, higher return on equity, faster growing earnings per share businesses at maybe a slight premium, but because they're growing faster, they quickly turn into a below market multiple 2 or 3 years down the road. Quoc, what is your portfolio management philosophy? For example, we know you own 20 stocks. What is your average starting position size? What is your average full position size? Do you typically hold cash, or are you fully invested?
Yeah, so that's a great question. So we typically size our new positions at a 1 or 2% weight, and then we'll build it up to a 4 or 5% weight at cost. We let our positions run and grow towards 8 to 10%. And at that level, experience has taught us that even though we may love it and everything is going as we expect, we trim it for prudence sake. Once you get beyond 10%, there's too much concentration risk in any one name. And typically our top 10 names make up over 50% of our portfolio. Cash is typically 1 to 3%. We think clients allocate to us for equity exposure. So we don't time the market and intentionally have high cash or low cash. We think in a concentrated portfolio, we can find a couple of good names in almost any environment.
How do you manage risk?
So this is very important. We take risk management very seriously, and we have several layers of risk management. I would break it down into 3 steps. The first one is security selection. By having a small number of holdings and watching them very closely, that fundamentally is where we spend most of our time. All of our companies generate free cash flow, can have reasonable debt levels, and in many cases have net cash positions. So the risk of a company going out of business is quite low. After the security selection, we look at concentration by sector. Our largest sector is tech, which makes up about a third of the portfolio. Healthcare is about 25%. But as we limit our individual position size to 5 or 6 at cost, as we add new names that may be in the same sector, a candidate to source it, might be trimming names in that sector or swapping a name in that sector. So sector concentration is important. And then the third level of risk management is one where we use some factor review. About 5 or 6 years ago, we studied factors and started taking advantage of the Bloomberg factor risk model. So we run some portfolio analytics to see which factors we are overweight and underweight. Not surprisingly, we are generally overweight growth factors like revenue and earnings growth, and we're underweight factors like dividend and value. But one of the learnings that we found was that trading factors like momentum and volatility often influences the portfolio, and we had not really paid attention to it. And so now when we add a new name, in addition to the fundamental work that we do, before we add the name, I look at that individual name's factors and compare it to our overall portfolio. And if this idea fits our criteria but has a much higher level of volatility, for instance, I ask, are we getting paid for this risk? Mm-hmm. This helps inform our sizing. So if a candidate has much higher momentum and volatility than our overall portfolio, we may start at a lower weight, say 1%. And if there's a drawdown in the name, it often draws down much more than our portfolio. And that's when we use that opportunity to average cost down and happily build it up to a full position. So this has helped us in sizing in and maybe being quicker to trim the higher volatile names, in our portfolio. And that has helped a lot.
Wow, that's an incredibly robust risk management system. Staying on a similar topic, a few years ago, you implemented 2 process improvements. Can you please share those with us?
Yeah. So at the time of the buyout, we did a 5-year look back on all of our buys and sells, and I wanted to use data to help inform me in terms of what process improvements we might make going forward. And this was really enlightening for me. What we found was that our buys generally worked out about 3/4 of the time. So we can underwrite growth businesses with strong moats. We can value them properly and have the patience to purchase them at reasonable prices. What jumped off our analysis was that our sells were 50-50. This is no better than a coin flip. And sometimes we would sell a stock because it had reached our price target, and we would high five each other, ring the bell, and sell it. But we would see that the stock would continue to compound at above average rates, and that was a mistake to let it go. Sometimes we would sell out of frustration, perhaps when a stock misses earnings, derates, and we felt that our thesis was wrong, only see the stock recover as they overcame some short-term problems. So this also was unacceptable. So armed with this data, I embarked on a study to see how we can improve our selling process. We spoke to other portfolio managers, dug deeper into behavioral finance biases, and decided to add a very important step in our research process, which we call a moat trajectory review. So every year, we employ a moat trajectory analysis where we meet with our entire team in a conference room with a whiteboard. We categorize all of our holdings into moats that are weakening, moats that are stable, and moats that are strengthening. And if a company's moat is weakening, we ask, will this change? And if not, why do we own it? I'll give you an example. In the spring of our 2019 meeting, we identified CBS, the media company, as a company whose moat was weakening. We purchased the stock after the Me Too movement scandal, and the stock had derated to about 10 times earnings and 10 times free cash flow. They were buying back shares and had the ability to grow, 8 to 10%. However, we knew that Disney Plus was going to launch in the fall and thought that the competitive landscape was getting much more competitive and that they did not have pricing power. So we decided to sell CBS. And by the end of the year, it had derated another 30%. So experience had taught us that cheap can get cheaper if the moat is weakening. I'm pretty certain that prior to this work, the prior team probably would have kept CBS because someone would have made the argument that the concerns are in the stock. Well, clearly it wasn't. At the same meeting, we identified Danaher as a business whose moat was strengthening. Danaher was in the process of purchasing GE Healthcare's bioprocessing business. And our research found that GE's business was likely going to grow faster and had higher structural margins than core Danaher. So while Danaher was close to our estimate of fair value, we decided to trim it from a 7 weight to a 5 weight instead of selling it outright. Well, this was a good decision because Danaher proceeded to double over the next 18 months. So the moat trajectory analysis has helped us keep our winners longer and hopefully identify moats that are weakening quicker and let those go faster. Now, the second research enhancement we made was to add some structure to our evaluation of our company's sustainability. After our initial look at a company, if we want to proceed on to a deeper dive, this is when we added an additional fundamental layer of work in looking at each company's work on their impact on environmental, social, and governance. And so here we score each of our companies E, S, and G on an internal scale of 1 to 5, with a 3 being the minimum required to pass our metrics. And then we also compare our work with third-party sources like Sustainalytics and Bloomberg's ESG metrics. And so what we want are companies that are growing businesses that are also treating their stakeholders responsibly. A great example of this is Ball Corp, which is a leading aluminum manufacturer who has a long runway of growth as aluminum takes share over plastic. But what's also really impressive is how responsible they are in the communities in which they operate, their efforts to promote sustainability, as well as equity and inclusion in senior management ranks.
Quoc, that was incredible. I think if anyone wants to learn how to become a better investor, just listening to your answer to this one question will take them a very long way. You're always looking to get better. You added these process improvements, and it's not just a moat analysis, it's a moat trajectory analysis. Some sort of first level moat analysis that I see just sort of lists the sources of moat. It may be, I think this company has a competitive advantage because of its brand or its scale or its network effects. But I don't see as much analysis around the sustainability and durability of those moat sources, as well as the year-to-year trajectory of that moat. Is the management team investing behind the moat and doing the things it needs to do to protect and widen that moat? And what you just shared and the examples you gave, I think should be a case study in Investing 101. So thank you for that.
Thank you, John. Maybe I can give an example of a company that we bought last year that I think is a good model of improving their moat trajectory that I'm particularly excited about. Every fourth quarter, we do an internal review of sectors that have underperformed, and we kind of dig through the rubble and see if there's anything interesting there. And last year, as you may remember, technology and semiconductors derated, where semiconductors were down over 50%. And we found a semiconductor supplier, a picks and shovel company called Integris, ENTG. And what was really interesting about Integris, we thought, was that there are multiple levers of growth. One is the modern semiconductors, the most advanced nodes, have over 3,000 layers, microscopic layers. And Integris's filters and chemicals helps purify the layers, avoid contamination, and enables manufacturers like Taiwan Semiconductor, Samsung, Intel, etc., to make the wafers. And if there's a speck of contamination, then that wafer is ruined. And so this provides an essential service. It's a picks and shovel where you often have to use the filter once and have to buy a new one. And it's a small cost in the total bill of sale of the manufacturing process. So they provide an essential service. So not only were they the leaders in this space, but they took advantage of last year's sell-off and bought a competitor, CMC Materials, as the market was drawing down. Shortly after the acquisition, they announced that they were selling non-core assets from the target. And so they've announced about $1 billion of asset sales, 200 million of which have already closed. They'll get another 800 million next year. And they'll use that proceed to delever the balance sheet, reinvest in the business, and potentially buy back shares. And so not only does this take out a competitor, but it makes them more relevant to their customers. And from a financial capital allocation lens, classic textbook of what to do, in a downturn, using some leverage appropriately and selling non-core assets to delever. Just multiple ways to win. And as the semiconductor manufacturing process recovers from the excess inventory from last year, this is in a great position, we think, to produce outstanding returns over the next 3 to 5 years.
Quoc, I'm smiling right now because once again, that was a textbook case of capital allocation, the case study you just gave, because once again, I think a lot of sort of first level thinking around capital allocation is, what is a company doing with its what is it buying? Is it making an acquisition? Is it investing in CapEx or R&D or working capital? And then what's it doing with its free cash flow? Is it paying a dividend, paying down debt, or buying back stock? But an often overlooked part of capital allocation is divesting assets at the right time, when you can earn a high return on that sale. And so once again, just an excellent investing lesson 101 that I often think gets overlooked is companies that are also really good at divesting at the right time. But the other reason I'm smiling is because when Integris fell down, I don't remember what it was, like $65 or $68 a share, I just got giddy. I was like, honestly, I was like, this is just, and like you just said, what I believe to be an outstanding buying opportunity. So you and I did not plan this ahead of time, but
no, we did not.
Yeah, just to say, I was literally giddy when I saw that stock sell off. So sticking with process, Quoc, this is largely a show exploring the research process that great investors put in place. And you talked about some of these additional process layers you added on, the moat, trajectory analysis, and the sustainability analysis. But can you just talk about your team's step-by-step research process?
Absolutely, and we spend most of our time researching. So this is an area that we love to do, and as investors, you're always making decisions about the future and with imperfect information. So we think it's really important to have a clearly defined process that's repeatable. So for us, we have a 3-stage research process. The first one is when we identify an interesting idea. This can be from our watch list or a company in a sector that's currently out of favor, or a corporate spinoff. Once we identify an idea, stage one is to research it. It can take a couple weeks. And we write a 5 to 10 page memo on what is the business, why is it interesting now, and what are the potential next steps. We probably do 1 or 2 of these a month. And so, maybe about a third of them progress to stage 2. At stage 2 is when we take a much deeper dive into the drivers of the business, the competitive analysis. This is when we use TGIS, which is an expert network service, to read interviews from former executives who've left at least 6 months from the company to learn about the drivers of that specific industry. We also will use LinkedIn and try and identify people that may be in our network who are experts in the space. And so we're really trying to learn as an operator, what are the drivers? What makes this company special? This is also when we layer our ESG review. This can take several months, depending on our familiarity with the industry and the company. But we're trying to talk to as many stakeholders as possible. This is also when we build out our own model and ask ourselves, what do we think this is worth to a knowledgeable private business owner? What is this worth in the sector relative to their competitors in the sector? If we decide to buy it in stage 3, this is when I layer on the factor analysis that we talked about earlier. How would this influence our portfolio? How do we size it? And if we want to add it, how do I source it? And so here I look at names that maybe have appreciated. I look at names in the sector that this company is in. I look at names that maybe we want to sell outright, and then we add it. But after we add it, that's when the work continues in earnest. We schedule quarterly calls with each of our investments. We try and visit with them every year. During COVID, it was more Zoom calls, but now we're happy to visit our companies, and we try to go to as many investor days as possible to be there and take a deep dive and refresh our underwriting. And we're trying to make decisions with imperfect information. And if you are a liberal arts student like I am, this is the best part of the business, where you get to just learn and grow a little bit every day.
I talk to a lot of investors, Quoc, and I don't think any of them that I speak to regularly, like I do to you pretty regularly, talk about the factor exposures. And I just think that's so important in today's market. It's one other layer of risk analysis that investors can incorporate into their process that I don't think enough investors are incorporating into their process. But with all the factor models and all the quant computers out there these days, all the passive indexes and ETFs, I just think layering in that factor exposure adds another layer and another edge to your process. So I really appreciate that. I'm just curious how often your team meets. I think you just mentioned that you go through one or two of these sort of shallow dives, 5 to 10 page write-up every month or thereabout. Is that about right? Is that about how often you hear new stock ideas? Y'all meet, once a month for those?
That's right, John. We have scheduled full research team meetings every day at 7 a.m. Pacific time. We meet, several times a day informally. And there's a different cadence depending on what season we're in. So during earnings season, most of our attention is, on our portfolio company's earnings, some of our competitors' earnings, or we'll read the competitors' transcripts, afterwards. Then we're updating our models, typing up our notes, and coming up with follow-up questions for management. Beyond earnings seasons, that's when we might do some maintenance work, some industry work, but that's also when we spend more time looking at new ideas. And so it's a cycle that has a nice cadence to it. We look at stage one ideas every month, sometimes a couple of times a month, and that's a lot of fun, particularly this time of the year as we look at sectors that may have underperformed this year, are there gems that have been tossed out. We really only add about 3 or 5 new names a year. So our turnover in names is about 20%, but we also will size up and down our positions. So, our daily meetings and periodic meetings, helps inform all of those decisions.
So just a couple quick follow-ups. So 20% turnover at the portfolio level, you're suggesting it's a little higher as you kind of trade in and out and size up and down. Is that right?
That's right. That's right.
The other thing I just wanted to say was every day meeting with your team at 7 a.m. I just think that's another indication of the rigor that you and your team put in and the passion that you have for the work. To have that quick meeting every day at 7 a.m. That's something that I really respect, especially during earnings season.
Thank you. Thank you.
Yeah.
It sharpens all of our focus because you don't go in the meeting, cold. You prepare for the meetings, and you want to contribute, at every meeting. So it's a very important process for us.
Absolutely. Yeah. One area that I think doesn't get enough attention is sourcing of ideas and how investing firms create their investable universe, so to speak. So how does your team typically source new ideas? Are you running screens? Are you looking at 52-week low lists? Are you looking at 13F filings? What does your idea generation process look like?
Yeah, so this is part of the hunting work that we do, and it's a lot of fun. We have a watch list of about 24 names, most of which we've either previously owned or would like to own, that we have, some familiarity with. We do run a screen with 5 criteria. These are, growth criteria, return on equity criteria, and that generates a list of about 125 names. We pay particular attention to new names that show up on the screen, as well as names that dropped off the screen. But screening is backwards looking. It's not forward looking. But it's a nice tool that we use. We look at sectors that are out of favor. We also think about where certain trends may be, in 3 to 5 years, and we try and come up with ideas, today that might benefit from that. And then we look at 13F filings from a handful of managers who we respect. So all of the above. But we were focused on companies that have a high return on invested capital, high ROE, a long runway of growth. Our investable universe is smaller than most, but we think that helps us focus on some of the best ideas that we can come up with for our clients.
Yeah, I love that, Quoc. 20 names in the portfolio and about 24 names on your watch list. Just a quick follow-up. You mentioned a couple of the metrics in that screen. Is there also a valuation component to your screen, or do you just do valuation on your own, build your own models later on in the process?
That's a great question. We used to have a valuation metric in the screen, and we dropped it because we want to find great businesses.
Yeah.
And then we will build our own models and valuation framework later. And that's when we decide, do we start a position now, or do we keep this in the watch list and wait for a break in the stock price? So it's mostly growth and return on equity criteria.
What do you look for in a stock pitch? Like, let's say your analyst knocks on your office door or comes into that 7 a.m. meeting and says, I have a team. I have a name I'd like to share with the team. What are you looking for your analysts to communicate to you in a good elevator stock pitch?
Yeah, so that's a great question. So one of the things that I look for is, what's the solution that this company offers? What's the problem that they're addressing? Is it unique with a competitive advantage, or can others compete away their margins? What's the market size, and can they extend and expand the addressable market? What are their capital allocation priorities? A great idea generally jumps off the page.
Mm-hmm.
What's interesting is a friend of mine did a study on 100 baggers over several decades. And you would think that most 100 baggers are technology companies. And there's certainly a lot of technology companies that are 100 baggers, but there are 100 baggers in every sector.
Yep.
And some of the criteria that we learned from this study was that these companies provided a novel solution that was differentiated. And sometimes it took 5 or 10 years for the market to recognize the superior business model of these companies. So you have time to find these companies, and they exist in every industry.
I like that message. You have time. You don't necessarily need to rush in at the IPO or when the expectations baked into the stock price may be extreme. You have time to do the research and to be patient with it. So I've seen some of the just extremely awesome and rigorous internal research that your team produces. You shared with me a long form research report that I think was about 40 pages, broken up by sections such as competitive advantages, growth and reinvestment opportunities, management and capital allocation, risks, valuation, ESG, and more. And these reports include visuals and charts and your models, your valuation. I'm just curious, does your team create one of these deep dives into each company in your portfolio?
Yes, we do. This is during our stage 2 work. And if anything, I have to tell our analysts to cut it down. We've had some reports that were 80 to 90 pages.
Wow.
And so 30 to 40 is about right.
Yeah.
The industry analysis and drivers of growth are particularly important. This packet is also helpful for us to refer back to our original thesis. From time to time, new developments come up. Maybe they made an acquisition. Maybe they're expanding into a new area. And so we asked ourselves, does this make sense? Does this make sense to their original core competitive advantage? Did they miss earnings because of a new technology, a competitor, or was it simply execution? So it's a living document for us, and we update it, with our quarterly calls and continuing work. But that original package is really grounding and important for us.
Yeah, and I love that it's a living iterative document that you're constantly updating. What do you expect of your analyst team? Are they generalists? Are they specialists? How many stocks do they typically cover on a day-to-day basis? What sorts of projects and assignments are you sending them?
That's a great question. Well, we're all generalists, but each analyst covers a group of related companies. So, for instance, one of our analysts covers the financials and healthcare. And so if we're looking at a financial name, it makes sense to assign that, to that professional. Another covers industrials and media. But we also, want to make sure that everyone is current on our whole portfolio. So when we meet with management, we all attend the meetings. When we meet with Wall Street analysts, we all attend the meetings, because there are certain threads that run across sectors, and so we want everyone to have exposure to that. And also, great management teams who are great capital allocators run across sectors. On a day-to-day basis, there's maintenance and earnings coverage. Projects include studying the impact of a new growth opportunity. So, for instance, the popularity of ChatGPT and generative AI. We're learning the difference between training and inference and what that might mean in terms of demand for cybersecurity and data. So these studies are really important for us to check to see if our companies are exposed there and can benefit, or will they be disrupted from some of the new trends. But we get up to speed on new names fairly quickly, and these projects are very additive to evaluate our current holdings and perhaps look at new holdings.
As a boutique firm, I assume that your analysts are wearing several hats. Is that the case? Is everyone sort of pitching in on other responsibilities above and beyond just equity research and portfolio management?
Absolutely. Everyone wears many hats. That's one of the joy of having a small firm. Our analysts primarily spend their time on research and looking around corners, but we all pull together, when there's something to do. Perhaps an important client comes in, and we'll think of some ideas to highlight, some sales to break down and explain. But it's nice when you have a small group of team, all rowing in the same direction.
Quoc, do you incorporate a macro view into your stock picking and portfolio management? And if so, what is your current macro outlook?
So we are stock pickers first, but we do pay attention to macro for sure. For instance, as the Feds near the end of the rate tightening cycle, I think it's really important to understand, which sectors may perform better over the next 2 to 3 years than perhaps the last, 18 months. Mm-hmm. Maybe we lean into that at the margin. We still own our core holdings, but an incremental add recently was Equinix, a leading data center company. And we've owned this in the past and got out before the interest rate hiking cycle. Because as interest rates went up, the multiples on REITs, contracted. And so this was on our watch list for several years. And only recently did we take a fresh look at it on our thesis that with the growth of generative AI, we think there'll be an increase in demand for their data centers, especially in the inference phase, where we think having data, at the end point is particularly important. And if the Feds are almost done with the rate tightening cycle, then perhaps the multiple contraction is over for the sector. So we think you could have multiple levers to win here, an acceleration in their growth rate, most importantly, but perhaps even multiple expansion if the Feds are done. So that's one way that we'll incorporate, view of macro into our bottom-up stock picking. Another example is, unfortunately, during periods of geopolitical wars, we'll see an increase in cyber attacks. So when Russia invaded Ukraine, the U.S. Department of Defense issued an alert to all U.S. companies to fortify their data and cybersecurity. We've owned Palo Alto Networks since 2019. This is a leader in the space, and so this helps reinforce why we own Palo Alto. So that helps inform and strengthen our thesis.
Yeah, I love how you put that. You don't change your core portfolio, but you may lean in to certain sectors or back away from certain sectors at the margin based on macro. So you may add a company here or trim a company there. That was super helpful. How do you think about valuation? Just talk to us a little bit more about your valuation process.
Yeah. So ultimately, you're buying a company for the stream of the future cash flow, and we discount it back to what it's worth today. So we build DCFs for all of our companies. We look at EV to EBITDA, especially if a company has some leverage. We look at valuation versus peer groups. We recognize that different sectors can have different valuation ranges. I use the analogy of homes. A 3,000 square foot home in the San Francisco Bay Area is valued differently than a 3,000 square foot home, perhaps, in Kansas City.
Yep.
So we think paying attention to the sector is important. We look at some of the parts and replacement value. One of the companies we own is Martin Marietta, a leading aggregates company. We know how many quarries they have and the estimated value of their quarries. So that's one of the factors that we have in terms of what we think the intrinsic value of that business is, in addition to the growth of earnings and cash flow. So ultimately, we're trying to find what is the best metric for that sector, with a heavy emphasis on the cash earnings and growth of cash earnings over time.
Awesome. Talk to us about selling. Under what circumstances do you trim a position, and under what circumstances do you sell out completely?
Yeah. So this is an area that we've worked hard on and continue to work on. Most of the time we're trimming, because if we're right on our theses, then most of our companies we should be holding for 5 to 10 plus years. So we'll size it up and down based on valuation and opportunities. But sometimes we'll sell out of a company if we find a better idea. Sometimes we make a mistake and our thesis just didn't work out. And sometimes if the thesis played out and we think the prospective growth opportunity is going to be lower than what we originally underwrote it at, then we'll let it go.
When you need to sell something to source a new, better opportunity, what types of situations do you gravitate towards selling in order to fund a new position? Are you generally selling something in the same sector, I guess is my question.
Yeah, so generally we are selling something in the same sector, but most of the time we're able to trim, a 7 or 8 weight, to a 5 or 4, to make room for the new idea. A new idea usually is coming in at a lower price to value or intrinsic value than an existing idea. So this is a high class problem.
Right.
For us, but most of the time we're trimming an overweight to make room for the new idea.
I'm curious, Quoc, from a mindset perspective, does being fully invested and having to sell or trim a position to add a new position, does that add a certain level of discipline and a scarcity mindset to the portfolio? In other words, you're not diversifying the portfolio by just adding new idea after new idea after new idea, but rather for something to make it into your portfolio. You started this conversation off by saying you live by Buffett's 20 punch card rule, basically. So for something to make it into your portfolio, it has to be better than your 20th best idea that's already in your portfolio. So I imagine that creates a very high bar for something to make it into your portfolio.
It does, and that's a lot of fun. Partly because the names that we do own, we think we know them fairly well. And so to add a new idea, to displace an existing name, it has to meet a very high bar. However, there's a little bit of a nuance here. In times of a market drawdown, what we have found is we're often able to use the market drawdown, which, unfortunately or fortunately takes down every name, to upgrade a couple of names in the portfolio. And so, one example of this is Microsoft, where we've long admired it, started looking at it deeply 6 years ago, but thought that it was fairly valued. And it was only during the COVID drawdown that we thought it was reasonably priced, and so we got in March of 19, and it's been one of the leaders since. And so in periods of a drawdown is when sometimes it's a little bit easier to upgrade the portfolio with higher quality names.
Absolutely. Quoc, how do you spend the quiet time in your office? What are you reading? What's on your computer screen? What administrative duties are you working on? Just when you're not in a meeting, when you're not traveling, when you're not listening to an earnings call, quiet time in your office, what are you doing?
Yeah. So both quiet time in the office and travel time are some of the most productive times for me. I love to read anything I can get my hands on. I listen to podcasts. But a recent book that I just finished is Power Failure by William Cohen, and it chronicles the rise and fall of GE. GE, believe it or not, was the largest market cap in the world in 2002. And so I was an investor during this time. We never owned GE, but to get the inside story of how GE grew to be the largest company in the world, and to see what mistakes they made, what led to their fall, was both entertaining and wonderfully, educational as a student of the market. So I would recommend that. It's a long book, but it's a great book. It reads really well. And I just started reading Michael Lewis's Going Infinite. This is more entertainment for me. But I love studying businesses, studying leaders in businesses, and how they built their businesses. And you realize that the CEOs and CFOs are humans. You realize that sometimes they make mistakes. And I remember during the .com era, a lot of Apple executives sold their Apple options or Apple stock, and they didn't know that this would be a 30-bagger, right? So it's really, I think, powerful to read biographies and books about businesses.
Maybe one more question, Quoc. What qualities do you think successful investors have?
So, I've been doing this about 25 years, and it took me over a decade to realize that once you find a great business, do whatever you can to hold on to it. One of the things that we learned in our 5-year look back when I bought the firm was we let go of some wonderful businesses because we thought that the valuation was reflected, was fairly valued. We bought Apple twice and made over 100% each time. But had we kept Apple, it would have been an over 30-bagger. We bought Visa and MasterCard when they spun out of the banks, and our theses were correct. And we made probably 3-baggers, 300% on those, which is a great return. But had we kept them, we would have had a 20-bagger. And so once you find an outstanding business run by an outstanding management team, work really hard to hold on to it for a long time. And that's the message I share when I speak at investment classes to students. It took me over 10 years, and I'm still working on that. But hold on to your winners as long as you can.
That's an incredible message to end the show with. Quoc, thanks so much for coming on the show, and I'm sure you and I will talk soon.
I really appreciate it. Enjoyed it, John.
Before we sign off, I'd like to provide a quick reminder. Anything discussed on the J. Rose Show by myself or my guest is solely our own opinions and does not constitute formal advice or a recommendation. The J. Rose Show is for entertainment purposes only, so please do your own research on any securities discussed in this podcast. Thanks for tuning in, and we will see you next time.